there's a large volume of evidence documenting that historically momentum strategies have outperformed, if an investor is going to incorporate momentum as part of their future investment portfolio, they'll want to have a reason why that momentum strategy actually works. In this learning objective, we examine the explanations for momentum such that we can identify the particular investment philosophies and particular view of markets that momentum aligns with. So there are three main explanations for momentum. One school of thought is that the returns generated by a momentum portfolio is capturing risk that's not explained by traditional models like the CAPM. However, the majority of arguments in the academic research suggest that momentum is a behavioural phenomenon. These particular arguments suggest that momentum can be explained by either underreaction to information or potentially a combination of both underreaction to information and subsequent overreaction to price performance. So if we look at each of these explanations, first of all, risk. So the idea of risk is that we know that investment strategies or assets that have a higher risk should be rewarded with higher expected returns. Now, one school of thought is that traditional measures of risk, such as the CAPM, are not the only source of expected returns. Perhaps there are additional sources of returns. Therefore, researchers have looked at whether the momentum strategy is related to other sources of risk, such as macroeconomic risk, and potentially whether winners are simply riskier than losers, therefore explaining higher expected returns. This argument was first put forward by Conrad and Call in 1998. However, there's been a large body of evidence that's shown that the momentum strategy does not appear to be explained by exposure to risk. Hence, this particular explanation has largely been debunked. However, one potential alternative risk-based explanation might be if we look at risk in a non-conventional, non-traditional sense. The majority of research that has suggested that momentum can't be explained by risk looks at the table we see on the screen here, and with a particular focus on the top two rows. So what we have here are the returns, the subsequent returns on portfolios formed based on past performance over the last 12 months. We hold the portfolio for the subsequent 12 months and then rebalance annually. So we end up with 10 portfolios from extreme losers based on past performance through to extreme winners. In the first row, we see that past winners subsequently outperform past losers quite dramatically. That's the momentum phenomenon, as we see as we increase the degree of past return performance, as we move from losers to winners, there's almost a monotonic increase in the returns that are generated. So a risk-based explanation should argue that winners would be riskier than losers. We look at the second row here, however, and what we can see that in terms of total risk or standard deviation, winners appear to be less risky than losers. And this was one amongst other arguments that's been put forward by research as to why it appears as though momentum can't be explained by risk. But what if we think about risk in a different context? What if we think about, for example, downside risk, or we think about investors that have different preferences, such as those that are called with prospect theory? Well, what we might want to consider are the skewness of this particular investment strategy. And in this third row here, I've documented the skewness of returns of loser portfolios through the winner portfolios. What we can see is, despite earning, on average, lower returns, the returns on loser portfolios tend to be quite highly positively skewed. So we can see a skewness coefficient of 1.8. Whereas the returns on winners tend to be negatively skewed. Now, if investors do have lottery preferences, that is, if they do have preferences for positive skew, they will be willing to accept a lower return for taking on that positive skew. So one potential explanation for momentum here is that the lower returns experienced by losers is basically just a compensation because of the lottery-like features of that positive skewness. Equally, investors with these preferences would be adverse to negative skew, and the winner portfolio is negatively skewed, and hence one potential explanation might be the downside risk of winner portfolios might explain those higher returns. Another way to think about this is to look at the time series of momentum returns across a period of time. So what I've got here is cumulative returns to the momentum strategy in the Asian region from 1990 through to 2012. So what we're doing here is we're got what we call a zero investment portfolio, where we take a long position in past winners and a short position in past losers and look at the cumulative returns. Starting from 1990 through to 2012, we can see that the trend is significantly upward. That is, the momentum strategy was quite an effective investment strategy that generated quite significant positive abnormal returns across this time period. But one interesting point to note is that there are two distinct periods across this time series where the momentum strategy had quite significant drawdowns. And this is what brings that negative skewness that we saw on the previous slide. These periods are also in some ways predictable in that the two periods correspond with the rebound of the market just post the Asian financial crisis in the late 1990s and just subsequent to the global financial crisis of 2008. So what we see is that following a market crash or a big market drawdown, in periods of high volatility when the market subsequently reverses, in those periods momentum actually does very poorly, and that brings about this downside risk to momentum strategies. So while risk as a whole has largely been debunked as a potential explanation for momentum returns, there may be one different non-traditional risk-based explanation due to these downside risk and these big negative drawdowns that we see. However, the more widely accepted view with respect to the root cause of momentum returns is that it is a phenomena that's related to behavioural characteristics of investors. So this begins with the view that investors as a whole tend to underreact to information. There's a whole lot of evidence in the psychology literature that shows that we as human beings underreact. We're very slow to update our belief system when new information comes to hand. So what this might result in is that you might have a firm, for example, that announces positive earnings results. That's good news, so the price should increase. But if investors underreact, instead of the price immediately jumping up to its new fundamental value, there might be a slow, gradual diffusion of that information into the price as investors slowly update their beliefs and knowledge, and that results in a price continuation because of that price drift. So underreaction can result in these price drifts or continuation of returns, and hence that's why it's been argued as it's potentially what explains momentum. Coupled with this idea of underreaction is the view that investors also tend to place too much emphasis on recent price performance. So investors underreact to information or to news, but actually tend to overreact to prices. This is known as the representative heuristic. And if investors then overreact to prices, what we might see is that we've got this initial underreaction. So new news comes out, let's say it's positive news, positive earnings announcement. The market is slow to react to that news, so there is a gradual price drift up to fundamental value. But then if investors are overreacting to price change, investors then see this price drift, this positive return. They overreact to that. So what that means is once the price drifts to fundamental value, it actually keeps drifting upwards in the positive direction further away from that fundamental value because of the overreaction or the over-extrapolation of that price trend. This is argued by Barbera, Schleifer and Vishny, and also Hong and Stein as part of their models of momentum. Now, while we might say that these arguments around underreaction and overreaction are merely just beliefs or arguments based on the characteristics we know about the psychology of investors, there is some evidence, if we look at the performance of a momentum strategy, that is associated with this belief system. So this is some research that was done by Jagadish and Tip in 2001, where they said that we can actually identify the root cause of momentum returns by looking at what happens to the returns on a momentum strategy in the period after our initial holding period of investment. So what we know about momentum strategy is that before we invest, so at time zero, which is this point at the start of the axis, we've ranked all stocks based on their past performance, and let's say that that's a period of the last 12 months. Based on our ranking over the past 12 months, we then identify our portfolio's winners and losers, and we invest for a period of 12 months across our investment period. With a normal momentum strategy, we would then rebalance every 12 months. That is, at the end of the year, we would then re-rank our stocks and buy or sell stocks within our portfolios such that our winners now reflect those stocks that were winners over the previous 12 months, and our losers those stocks that were losers over the previous year. But what if instead of rebalancing annually, we just had held that same portfolio for a period of 5 years? It's important to look at what different price patterns across that subsequent period after 12 months tells us. Now, if momentum was explained by risk, that would mean that winners are riskier than losers, so winners would constantly have a higher expected return than losers. So we should see on average that the winners would outperform losers over the investment period, But then because they're still exposed to higher risk in the subsequent period, we should see a continuation of the outperformance of those past winners right out through time. So if we held the portfolio for 60 months, we should see that every one of those 60 months on average, winners should outperform losers. If momentum was just explained to underreaction to information, what we should see is the price drifting for a period of time. Let's say that period is the investment period. Price drifting until it gets to fundamental value. That is, until the information is fully incorporated into prices. But then there should be no abnormal returns afterwards. That is, there should be no difference in the returns of winners or losers across the subsequent period. Okay? Because once the prices get to fundamental value, there should be no abnormal returns systematically achieved by either winners or losers. So this pattern here, where we see the momentum phenomena, but then subsequently no abnormal returns, will be consistent with an underreaction story. If there was a combination of underreaction and overreaction that we spoke about before, what we would see is we'd see the price drift and price continuation. But because the subsequent overreaction pushes the price further away from fundamental value, we should eventually have arbitrageurs who come in and return the price to fundamental value. So you should actually see some mean reversion, whereby you find that after that initial year, in the subsequent period, so if you held that portfolio as we've got here over a longer period of time, you would see winners actually underperforming losers from, say, month 13 through to month 60. So if we look at the actual pattern of returns of momentum strategies across time, we might be able to differentiate between these arguments. And what Jagadish and Titman show is evidence that appears to be pretty strongly correlated with the expected pattern that we see by this argument of underreaction coupled with overreaction prices. So we see this momentum phenomena, so there's this price drift, this is momentum, so we form our portfolio, winners versus losers, winners outperform losers for a period up to about a year, but then we consistently see across all different time periods here this mean reversion. That is, the returns of winners actually underperform losers if you had have not rebalanced and had have kept holding that same portfolio out to, say, 60 months. So this price pattern of returns tends to suggest that momentum is explained by behavioral phenomena. That is, momentum is consistent with an investment philosophy where you believe that there is less than perfectly efficient markets and that a market failing might be due to behavioral biases of investors that's consistent with the psychology literature suggesting investors underreact to news and overreact to past price performance.